Good afternoon, everyone, and welcome to the latest Fisher webinar series event. This series is all about connecting alumni, friends, and partners of Fisher College of Business with thought leaders and experts here at Fisher who are helping shape the future of business. Today, we're excited to be joined by Doug Farron, Executive Director of the National Center for the Middle Market. Doug will take us behind the scenes of the market that keeps America's economy running, share the latest insights into what leaders at these companies are saying about topics such as tariffs, hiring, and infrastructure investment, look ahead to what all of it means for all of us as consumers heading into the holiday season. And now I'm pleased to introduce the National Center for the Middle Market's Executive Director, Doug Farron.
Hello, everyone. Pleasure to be joining you all today, and grateful for the opportunity to share a little bit more about our center and what we do here at the college. So as Kim said, my name is Doug Farron. I'm the Executive Director of the National Center for the Middle Market, and I'm going to take you through the next 30 minutes or so, share more about exactly what that means when we say middle market, some of the latest data that we collect in our semi-annual surveys, and then focus specifically on an industry of importance as we reach the holiday season here, which is middle market retail, and tell you a little bit about what these companies are thinking and how they're responding to some of the challenges that are out there. So kind of just ran through this agenda for the session. Again, I do want to tell you a little bit about the National Center for the Middle Market, and then specifically our Middle Market Indicator Report, which is what I'll be focusing on today. Talk about some of the issues that are out there. We are seeing a definite change in the posture that these companies are taking, given things that have happened in the first part of the year and into the fall. And then, as I said, focus on the retail industry a bit. So about our center, we were launched over 14 years ago. So October 2011. The center was created as a partnership originally between the Fisher College of Business and GE Capital. We exist for really one purpose, and that's to help support the growth and success of these companies. We really think about our activities in a few different buckets. Conducting research, which our middle market indicator is a part of. We also do topical studies. We've created some benchmarking tools in the past where executives can go and kind of compare themselves to their peers. So that's kind of one bucket of activity. We also do quite a bit of outreach and engagement. So Kim, myself, other members of the team, we're traveling really coast to coast to present these insights and this data to various audiences, because we are the first and only center focused on the middle market. So we're the only ones that have access to this. Some other service providers tend to survey middle market companies, but it's typically a much smaller and concentrated set or group. And it typically is very narrowly focused on, say, an industry or on a certain set of products or services, whereas we try to cover the entirety of the market. The last thing we do is education. So we think about taking this curriculum, or actually we take the content and we've created curriculum here for our students, particularly in our industry immersion program for undergraduates, but we're also training executives. And we have a partnership right now between the Ohio Chamber of Commerce, our non-degree executive education team here at the college, and the center to help middle market companies here in the state of Ohio how to learn how to scale their business. So that is supported by NCMM Insights. So I'm going to take you through one of those today. First, a little bit about our team. We're small but mighty. We also leverage quite a few partners. So I've been with the center since we launched in October 2011. Prior to that, I was here in towns with L Brands in supply chain and logistics. I'm also a grad of the full-time MBA program. Kim Risler is our program manager. She's been with the center for the last 3 years, also as an alumnus of the Working Professional program. And we have a current Fisher student, Lacey Bufo, who works as our intern, helping us with a lot of our marketing activities. We also have some external partners, RTI Research, Rattleback. We do some work with a group called ThunderTech. And of course, we leverage partners all across both the college and the university. So what do we mean when we say middle market? Well, technically, we use a definition of businesses with annual revenue between 10 million and $1 billion. That's a huge range. We know that. But when we launched using that definition, there were about 200,000 companies in the US that fit that description. And it almost perfectly represented the middle third of the US economy in terms of private sector GDP and employment. So we get questions all the time about, well, what is the number today? And can you tell us, how many of these companies are in Columbus or how many in the Midwest? It's constantly changing. It's a very fluid number. There is a lot of growth into the middle market. There's some growth out. There's a lot of consolidation, M&A activity, private equity activity. But more importantly than the technical definition, these are businesses that are bigger than startups and smaller than large multinational enterprises. We really start to think more about the issues and challenges and opportunities they face rather than just the technical definition. You can see here, they're spread all over the country. I've got a couple of maybe more recognizable logos, but the fact is 90% or more of these companies are privately held, and many of them are within the supply chains of larger companies. So the brand names you probably wouldn't know. They tend to be a lot of B2B, again, not strong consumer brands necessarily. There are some retailers that are a little bit well known, but again, they tend to kind of fly under the radar. And another one of the reasons why the center was created was to help bring some more notoriety to these companies. 11 trillion in revenue, fifth largest global economy if the middle market was its own country. So a lot of good reasons for us to study this. Again, what I'm going to focus on here in the next 20 or so minutes is sharing the latest insights from the Middle Market Indicator. As I mentioned earlier, it's a twice annual survey we conduct in June as our mid-year, which I'm going to share from June of this year. And then we're getting ready to actually go into the field here in December for our year-end survey. So that gives us a chance to really keep our thumb on the pulse of middle market performance, sentiment, confidence, where they're investing capital, how they're expanding, some of the challenges they face. And of course, we have the ability to also look at, very topical issues, whether they be talent management, technology, or in this most recent wave, looking at trade and tariffs. And so we'll talk a little bit about that as well. So let's start with the very first question in the survey, which is, what are the strategic objectives for middle market companies? You can see here that it's really about the two things that most successful businesses focus on, which is increasing the top line and increasing the bottom line by controlling costs, operational expenses, improving margins, things of that nature. You can see we've got, ranked in the top 5, it's growing revenue, increasing margins, expanding the customer base. More so, we're seeing investment in technology. I'll talk a little bit more about what that means. But they're kind of ranked in order here from ranked first in terms of a priority. So clearly, these companies focus on growth, but also profitable growth. If I could only share one slide today, it would probably be this one because it captures quite a bit of the key data in terms of economic performance that we capture in this survey. But this is what we call our kind of metrics chart or dashboard. You can see here we're looking at things like revenue growth in the last year, a little over 10.5%. Employment growth, almost 7.5%. You may ask, well, how does that compare to other size businesses? Well, we do have the ability to compare revenue to the S&P 500, which was 0.5% in the same time period. So middle market revenue is growing faster than large companies. Similarly, from an employment standpoint, we use a report from ADP, the large payroll and HR services provider, who publishes a monthly report. It's based on headcount, not on revenue, so it's not a perfect match, but it serves as a good proxy for us to compare to. And you can see that large businesses were growing at about 2.5% headcount, and small businesses under 0.5%. So once again, the middle market growing much faster. And this kind of matches what you're hearing in the news. Lots of big companies talking about layoffs for various reasons, AI and other things. but the data matches the narrative here in that the middle market tends to be really steady growers in terms of both the top line and employment. And then we think about the next 12 months, so through the middle of next year, these companies were projecting a little over 8% top line growth and about the same level, 7.5% of employment growth. We also track capital investment, and a little over half of the companies are telling us that they are taking money from their sales and revenue and investing it back in their company to help drive growth. We'll look a little bit at where those areas of investment are happening. And then finally, from a confidence standpoint, we measure global, national, and local, and these numbers tend to shift, maybe percentage point or two from wave to wave, but the trend is always the same. The local confidence for these businesses is always the highest because it's where they typically have most of their customers, their suppliers, their employees. It's their backyard and it's the area that they know the best. So that's where they tend to be the most confident. This is just a trend data going back to the start of the middle market indicator. Just an explanation here. The blue line that you see represents the average percentage revenue growth rates. The orangish yellow line is the average employment growth rate. So you can see from 2012 when we launched this up until 2019, very consistent. A couple of spikes in there. I mean, we can point to the first quarter of 2017 was a post-election year, but for the most part, I would say very, very consistent performance from both a hiring and revenue generation standpoint. Of course, the bottom falls out in the spring of 2020. We see the massive drops, which tells us the middle market was not immune to the pandemic. But since that time, we had a resurgent and quite impressive recovery. I've kind of boxed the last 4 years to see that, pre-pandemic, average revenue growth was 7.5%. It's been over 12%. And this is the first time since 2020 that we've actually seen significant decreases in both the revenue and employment growth. So something for us to keep our eye on. We know that there are a lot of macroeconomic things happening out there that are influencing these companies as well, and we continue to monitor that. From a revenue percentage growth rate, this is an interesting chart because it goes back to 2021, and these different categories are really showing you the fast growers versus the steady growers versus maybe the flat growth or declining. The good news is, those companies increasing revenue 10% or more, staying pretty consistent. Yes, it's down from just a year ago, and in the middle of 2024, almost 6 in 10 companies told us that they were growing at 10% rate or higher. That's down to about 50%. The better news, though, is you look at the bottom, the flat or declining companies are actually holding very steady. They're actually trickling down a little bit from 22% 4 years ago to where we're at now, which is about 15, 16%. We also have a chance because of the size of the sample. I mean, we talked to 1,000 companies across the country. I'm not sure I mentioned that, but this survey goes to founders, owners, CEOs, CFOs, senior leaders, and decision makers at 1,000 businesses from coast to coast. And then we weight this data to the US Census. So because of that sample, we can look at this information many different ways, and industry is one of the more popular ones. This is for revenue growth. We can see that the fastest growing industries through the first half of this year were in services, which are typically B2B services, financial services, and construction, which we know to be a very seasonal industry. Manufacturing, actually quite impressive as well, at just under 12% revenue growth. So a question I typically get is, well, hey, inflation has been high, interest rates have been high. Is this really truly growth, or is it reflected in the fact that these companies have been forced to raise their prices, raise their rates as a result of inflation? And while that is true, we also are able to track expansionary activity. So what companies are doing to organically grow their companies. And these are some of the more popular. You can see that in this latest wave, Introducing a new product or service is something that over half the companies told us they've done in the last 12 months, as well as expanding into new domestic markets. About 4 in 10 companies doing that. Much lower down the list, we have things like adding new facilities, taking on new debt. Of course, interest rates still quite high, particularly as we think back to pre-pandemic when borrowing a dollar was essentially free. So yes, there is activity happening to drive organic growth. Employment, kind of similar chart to what I showed earlier. So this is the percentage of employment growth across different buckets. And you can see that 54% of the companies tell us their workforces are increasing. Those green areas are the higher levels. So 36% said that they grew their staff 10% or more. The change is really when you think about the no change. There's not many companies that are letting go of workers, which is good news, because again, we saw this in the financial crisis of 2007, 2009. Big companies were shedding jobs. Middle market companies were actually taking advantage of that talent accessibility and continue to add. So they were growing while big companies were shedding. And right now we're seeing, very few companies laying off, but close to half saying that they are staying flat. Similarly, we can look at employment by industry. Not surprisingly, some of the fastest growing revenue industries also match the fastest growing employers, which would include, again, financial services, manufacturing, which I mentioned earlier, retail trade, which we're going to talk a little bit more about here toward the end, and then the construction industry. Confidence. So this gives you a sense for the trend of where confidence has been over the last 4 years or so. I mentioned that consistency of the local being highest. You can clearly see that here. Kind of the aqua green line at the top is the local economic confidence. It's actually up just a percentage point from where it was in the middle of 2024. But down from where it was last December, which was right after the election. There was a lot of, kind of post-election exuberance around, business-friendly administration, and we're seeing that drop. And we're going to be capturing kind of new numbers around this shortly. We'll see if this kind of trend down continues. But you can see that consistent pattern with local leading national, leading global. Investment planning. So another interesting kind of trend chart here. We asked companies, if you had an additional dollar of revenue, would you do with that dollar? And again, pre-pandemic, it was pretty much a consistent trend that between 65 to 70% of companies were reinvesting that money. Of course, it flipped in the first year of COVID, and we've seen it kind of slow to recover. It's been lagging these very impressive growth rates, into the high 50s and lower 60s. This time it's at 56%. So companies are kind of holding back a bit. It's a very tough economic environment. They're also thinking about what investments make the most sense for them. And as it relates to those who are investing, the pie chart that you see here on the left are the areas where companies are putting their dollars. And for the first time, we see AI emerge as the number one target for investment. Over 20% of the companies tell us that is their number one source for investment, followed by just general and broader information technology. These could be SAP, ERP systems, CRM, those type of things that help the back office become more efficient, save costs, things like that nature. Further down, you see things like plant and equipment, facilities, training, so on and so forth. Those who are saving, which you see on the right, over half of them are saving for some future investment. Perhaps it's an acquisition. Perhaps it's a new technology platform. Don't necessarily know what those are, but they're sitting on cash and waiting for either conditions to improve or the right opportunity to emerge. The challenges that they're telling us about, we bucket these into some broader categories. So economic challenges like rising costs of materials, inputs, economic uncertainty, followed by talent. Talent has been in the top 1 or 2 challenges since 2015. A lot of these companies struggle to find enough workers and the workers that have the right skills that they need to help support this impressive growth. We're also seeing things around regulations, such as tariffs, big issue, and as well as operational challenges. So this kind of breaks it down in a little more granular detail. The number one challenge being, again, as I mentioned, inflation and rising costs, followed by the impacts of tariffs and trade policy, overall uncertainty, and then attracting and retaining the talent. See some other things that we hear quite frequently. Cybersecurity, as more technology becomes integrated, there becomes more threats and risks to proprietary data or confidential customer data. So a lot more focus on those types of issues, data privacy and security. We can also see things on rising wages. We're going to be looking at things like healthcare costs. We've heard in the most recent days here about some of the challenges around that. So again, lots of issues for these leaders to think about. These are some of the top risks. So similar to challenges, with a lot of the policy change that went into effect this spring, supply chain risk is now ranked as really the top risk. We saw this during the pandemic when there were port closures and the flow of materials became disrupted, that a lot of supply chains were disrupted accordingly. And now that is the case again as companies think about how to manage a tariff policy effectively. Cybersecurity, as I just mentioned, another risk, digital technology, how to properly implement, maybe properly how to pick the right technology, and the use cases for things like AI are risks for these firms as well. A bit on tariffs. So as I mentioned, we did ask some questions shortly after the announcements of a lot of the tariff policy as to the changes that it would mean for the middle market. As you might expect, a lot of these companies said that we're going to increase our prices, or we may just eat these costs and it will mean reduced profit margins for us, which has trickle-down effects, meaning less investment, less purchasing of other things, as I showed earlier, delays in the supply chain. A lot of companies concerned about this. Over 40% of the companies are extremely or very concerned about the impact over the next 12 months. And then current or anticipated impacts on the business. I'm going to focus you to the bottom right area. The most critical or significant impact would be to costs of goods and materials, overall profitability and margins, because again, there's going to be impacts on both of those levers, supply chains to stability and reliability, and then the ability to plan and forecast are some of the top challenges that companies are facing. And again, I'll just use an example. Not many middle market companies extract a significant portion of their revenues from international markets. However, they do source quite a bit. So let's just take North America. Less than 5% of revenues come from Canada or Mexico, but over 30% of raw materials for middle market companies come from Canada and about 25% from Mexico. So they are significant sources of supply, and they're interwoven within the supply chains. And changing that dynamic and thinking of a new supply chain approach isn't always quick or easy or cost effective. So companies are still trying to think through that a bit. Another big issue when we think about talent is about transition. So a lot of companies are reaching the point where the founder owner may be at that stage where they're looking to exit the business. What does that mean? It could be an intergenerational transfer, family, new member of the family takes over. But if that's not the case, what's going to be the exit strategy? Is it merging with a competitor? Is it perhaps selling to private equity? Is it consolidating with another in the industry? So, you can see here it's actually gone down a bit. About 3/4 of middle market companies say they're not likely to transition in the next 24 months. But if you extend this out to 36 months, maybe even a little longer than that, that number does spike up quite a bit. So we feel there's going to be a significant ownership change over the next couple of years, which will have all types of implications as it relates to technology and management practices and things like that. The technology focus for the next few years tends to be, again, in things like AI. We can see it on the right. Almost 50% of companies say they're going to be investing in intelligence tools, things like CRM software that gets them closer to the customer, accounting software, expense management, things that bring more productivity to the back office. Some of the barriers, I mean, as you can expect, the benefits would be saving money, time, having a competitive advantage. But really, we're talking about companies that often face big company issues with resource constraints. So they're telling us they often lack the budgets to support some of these changes. They often lack the time and the team, small IT departments, small support staffs. They're really focused on what they do best, and oftentimes they lack those resources. So this is where they're turning to their trusted advisors for that help. And then for me, AI utilization, the biggest thing that we've seen over the last 2.5 years was that previously middle market companies were very slow to adopt. They were testing and maybe learning about AI. And if you look at the bottom right there, now close to 6 in 10 companies are starting to actively train their workforce on AI tools. Again, those tools vary by industry. It's often a use case within these companies, but is something that's becoming far more popular. So I want to spend the last few minutes really just focusing in as it relates to retail and what that might mean as we get into this holiday season. So just to level set on middle market retail, again, companies between 10 million and a billion. We're talking about traditional brick and mortar. We're talking about e-commerce companies. We're talking about restaurants, chains, and bars and things of that nature. For those in Central Ohio, I mean, the Cameron Mitchell restaurants would be a perfect example of a middle market retailer. They operate restaurant chains here both in Ohio and nationally. So while it represents less than 1% of all retail companies, it employs close to 16% of the workforce and generates 15% of the revenue in the entire industry. So you're going against, the behemoths of the Amazons and so forth. So middle market, in terms of companies versus how they contribute, punches well above their weight. They are also growing pretty impressively. You can see here the trend chart. So the blue line, had been averaging about 12% revenue growth prior to this wave. Now they're down to 10.7. Actually, the retail trade growth in the industry is 10.5 versus the overall middle market, which was that 10.7 that I mentioned earlier, and projected to be about 9% in the coming year. About 70% of the companies are projecting year-over-year revenue growth within the retail industry. So these are all good signs. They point toward a healthy middle market retail industry. Similarly for employment, the growth in employees has actually been a bit higher. You can see at the year end, it was closer to 11.5%. Now we're at about 8.5% and projected to be 9%, which again is a little bit higher than the rest of the middle market as a whole. And about half of the companies have told us that they have increased their employment year over year and are expected to do so in the coming 12 months. So what are the top challenges? I've just kind of put these on a list here. Inflation and costs. Again, the retail industry heavily reliant on a lot of materials. You think of apparel, you think of consumer goods. So costs, big concern. Tied right there with tariffs. Again, a lot of materials get sourced from different countries, and to the extent that they're facing tariff challenges could be a big issue for these businesses. They're also facing rising labor costs. The cost of capital remains high, and of course, supply chain disruptions. The specific impact of tariffs, kind of similar to the chart I showed earlier, concerns about supply chain reliability. So as consumers, how does that affect us? Well, you may find empty shelves or less inventory as you go to buy things for the holiday season. We had a podcast earlier this fall with a supply chain financing expert from Wells Fargo who told us a lot of their clients kind of planned ahead. They bought excess inventory to be prepared for the holidays. But again, due to forecasting issues, is that going to last through the entire season? And then what happens when January and February hits? So the message there was we may be okay as consumers for the next 6, 8 weeks. As we get into 2026, what does that inventory look like for us when we want to go buy things? Pricing products competitively, another big tariff challenge, planning and forecasting. So AI is a tool that a lot of retailers are using. How are they using it? Well, they're doing a lot of analytics and modeling. They're thinking about customer behavior, buying patterns, which then affects production and inventory. They're automating a lot of routine tasks, which helps free up people to do more productive work. They're using machine learning, robotics, as we think about some of their distribution and things of that nature. But a bulk of them say we're using AI for all of this. It's become a communication tool, it's become an automation tool, and it's become a way to really address two things: rising costs and talent shortages. That's really the play here with AI, and it's only going to continue to get higher utilization over time. So that's really the gist of what I wanted to share today. Again, middle market's doing well, although this is the first time in at least 4 years that we've seen this type of slowdown. Companies are being very cautious with all the uncertainty out there about where they're placing their bets and making investments. We see significant challenges around just the macro economy as a whole and trade policy. But AI is becoming a tool to offset some of these uncertainties, drive productivity, address costs and talent challenges. And I just want to leave you with a couple of additional notes on some of our research. Just today, we released a new report on the Canadian middle market. While global middle market economies aren't necessarily our focus and mission, we do know that the US is, and really North America, is so intertwined from a supply chain standpoint. So for the last 2 years, we've been collecting data on middle market companies in Canada. We just released a report on that today. Earlier this fall, we released another report on private equity in the middle market. It's becoming a much bigger piece of the pie when we think about ownership and investment, not only just for the capital, but also for the sophistication and operational levers that can be pulled to help continue to drive growth in the middle market. And we're getting ready to launch a new project with a company called CBiz in Northeast Ohio that'll be looking at how middle market companies make their decisions and trade-offs in the face of these resource constraints that I mentioned earlier. So with that, I would invite you to check out our website. It's middlemarketcenter.org. We publish all of our information for public consumption. So I invite you to go check out our library of content, our data. That we have spreadsheets that you can go and look up certain industries and try to uncover more insights about the middle market. But that we exist for that purpose. And I'm just thrilled for the opportunity to be able to present some of those insights to you today.